Next transaction which we are going to see is paid salaries. So here if you see, salaries is one of the account, and you pay salaries through cash. When they do not mention anything, it is to be considered that it is being paid through cash. Therefore, cash is another account. Salaries belong to the nominal account and cash belongs to the real account. So, nominal account rule is debit all expenses and losses, credit all incomes and gains. Therefore, salaries is an expense. So, since it's an expense, we are going to debit it. Likewise, we are paying salary. Cash is going out of the business. So, according to the real account rule, debit what comes in, credit what goes out. So, whatever goes out, I'm going to credit it. Therefore, salaries is debit, cash is credit. So, the journal entry is salaries are converted to cash account, the narration being paid salaries and the amount being recorded. Let's move on to the next transaction. The next transaction is paid salaries through ECS. So this is similar to this, but here we are paying salaries in cash and here it is ECS. ECS means electronic clearing system, which is a system that is given by the bank. So bank account is one of the account, and likewise from the previous transaction, it is going to be salaries as another account. So when we take bank, bank refers to a personal account and salaries is a nominal account. So according to the personal account rule, debit the receiver, credit the giver. The bank is paying salaries. Therefore, bank is going to be the payer or the giver. So we are going to credit bank. According to the nominal account rule, debit all expenses and losses, credit all incomes and gains. So since salaries is an expense which we are going to spend on, so salaries is going to be debited. So salary is debit, bank is credit. So journal entry is salaries are converted to bank account. So paid salaries through bank and the amount is recorded. So the difference between the previous one and this one is it's paid through cash, so to cash account. This is paid through bank, so to bank account. The next transaction, sold goods to Mr. M and cash received. So this is more or less, it looks like a credit transaction, but you must take into consideration that the cash has been received. Therefore, it's a cash sales. So for cash sales, we have two accounts involved. One is cash and the other is sales. So cash and sales, I'm going to consider it as a real account. So what comes in and what goes out, that's all I got to find out. So when I sell, cash is coming into the business, and when I sell, goods are going out of the business. So debit what comes in and credit what goes out. Simple. So cash is debit, sales is credit. So journal entry is cash account debtor to sales account, and the narration is cash sales, amount being recorded. Next transaction is purchase furniture by cash. So here we have a property which is furniture and a property which is cash. So both furniture and cash are belonging to the real account. So I got to figure out which is coming in and which is going out. When you purchase furniture, furniture is coming into the business and you pay through cash, which is going out of the business. Therefore, furniture is debit and cash is credit. Here you can ask me a question, why didn't we take purchases? We take purchases only when we purchase goods. We never mention goods in the journal entry. So because of that, we take purchases. But here we purchased an asset, a property. So we take the property. So journal entry is furniture account debtor to cash account, purchase furniture and the amount is being recorded. Next transaction, we are going to see goods returned to Mr. D. So goods returned to Mr. D means we have purchased from him and we are going to return it back to him. So that is called as purchase return account. Likewise, Mr. D is there. So Mr. D is going to be one of the account. Here no cash is involved, therefore purchase return account and Mr. D account. Now purchase return account, again I can refer it to a real or a nominal account, but I am taking it as a real account. And Mr. D is a name, so personal account. So according to the real account rule, debit what comes in, credit what goes out. Now I am returning goods back to D. So my goods are going out, therefore I am going to credit it. Now Mr. D is receiving the goods, so he is a receiver. Therefore, I am going to debit it according to the golden rule of the personal account, debit the receiver. So, Mr. D is debit, purchase return is credit. So, the journal entry is Mr. D account debtor to purchase return account, return goods to Mr. D as a narration and the amount being posted. Goods returned by Mr. E. By Mr. E. So, that means we have sold the goods and Mr. E is returning back. So, we have a name over there which is Mr. E, and when we sell goods and they are returning it, it's called as sales return. So these are the two accounts involved. So now Mr. E refers to personal account and sales return refers to real or nominal. I am taking it as real account. So Mr. E is giving the goods. Therefore, he is going to be credited and goods are coming into our business as sales return. So, it's going to be debited. So, sales return is debit, Mr. E is credit. So, sales return account debtor to Mr. E account, goods returned by Mr. E. Next transaction is commission received. So, it's obvious you're going to receive the commission through cash and we are receiving commission. So, commission received is the other account. So cash account is belonging to the real account and commission received is going to be with the nominal account. So according to the real account rule, debit what comes in, credit what goes out. You're receiving commission in the form of cash. So it's coming into the business. Therefore, we are going to debit it. Likewise, commission received is a nominal account. So debit all expenses and losses, credit all incomes and gains. Since it's an income, we are going to credit it. So cash debit, commission received is credit. So journal entry is cash account debtor to commission received. The narration being commission received and the amount to be posted. So next journal entry, if you see the transaction is interest received directly by the bank. So one account is going to be interest received and the other is going to be bank. So let's take and write bank and interest received. So bank account refers to personal and interest received refers to nominal. So according to the personal account rule, debit the receiver, credit the giver. So bank is directly receiving. Okay, receiving the amount. Therefore, we are going to debit it. Interest received, nominal account. So debit all expenses, credit all incomes. Interest received is an income. Therefore, it's going to be credited. So bank is debit and interest received is credit. So the big difference between this one and this one is there commission received through cash, here interest received through bank. So journal entry is bank account debtor to interest received directly by the bank as a narration and the amount to be posted. The next transaction is withdrew cash for personal use. So whenever we find the word personal use in the transaction, it always refers to one term called as drawings. So personal use means the proprietor is withdrawing money from the business. So the other account is cash account. Always drawings will be debited. If you take drawings, it refers to personal account and the proprietor is receiving the money. Therefore, debit the receiver. Cash account refers to real account and the money is going out of the business. Therefore, credit. So, drawings is debit, cash is credit. So, the journal entry is being drawings account debtor to cash account, amount being posted and the narration. So, next one we have is withdrew goods for personal use. So, here it's goods for personal use. I told you whenever you find the word personal use, it's going to be drawings account. Likewise, when it's goods, we never use goods in the journal entry. Therefore, whatever we purchase and keep it for our customers, from that only the proprietor is going to take and use it. So, we are going to use purchases over there. Right? So, drawings refers to the personal account and the proprietor is going to receive the money, therefore debit it. And goods are going out of the business. So, I am going to take it as a real account and it's going out of the business, therefore credit. So, the only difference between 19th and the 20th one, there he is withdrawing cash. So, cash is credited. Here he is withdrawing goods, therefore purchases will be credited. So, journal entry, drawings to purchase the account. Narration being withdrawn goods for personal use and the amount posted.